Monetary Policy Committee held its 53rd meeting from February 5 to February 7, 2025, under the chairmanship of Shri Sanjay Malhotra, Governor, Reserve Bank of India, and unanimously decided to reduce the policy repo rate under the Liquidity Adjustment Facility by 25 basis points to 6.25% with immediate effect. Consequently, the Standing Deposit Facility rate shall stand adjusted to 6% and the marginal standing facility rate and the bank rate to 6.5%. And it also decided to continue with the neutral monetary policy stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. These decisions are in consonance with the objective of achieving the medium term target for consumer price index inflation of 4% within a band of plus minus 2% while supporting growth. In the statement of RBI governor, he said that the global economic backdrop remains challenging. The global economy is growing below the historical average, even though the frequency indicators suggest, along with the continued expansion in trade and progress on global disinflation is stalling, hindered by the services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened and bond yields have hardened. Emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions. Divergent trajectories of monetary policy across advanced economies, lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee coming under depreciation pressure in the recent months. On the domestic front, as per the first advance estimates, real GDP is estimated to grow at 6.4% in 24-25, supported by recovery in private consumption. On the supply side, growth is supported by services sector and a recovery in agriculture sector, while tepid industrial growth is a drag. Looking ahead, healthy Rabi prospects and an expected recovery in industrial activity should support economic growth in 25-26. Among the key drivers on the demand side, household consumption is expected to remain robust, aided by the tax relief in the Union Budget 25-26. Fixed investment is expected to recover, supported by higher capacity utilization levels, healthy balance sheets of financial institutions and corporates, and government's continued emphasis on capital expenditure. This is corroborated by positive business sentiments highlighted in the Reserve Bank's enterprise surveys and PMIs. Resilient services exports will continue to support growth. However, headwinds from geopolitical tensions, protectionist trade policies, volatility in international commodity prices, and financial market uncertainties continue to pose downside risks to the outlook. Taking all these factors into consideration, real GDP growth for 25-26 is projected at 6.7%, with Q1 at 6.7%, Q2 at 7%, and Q3 and Q4 at 6.5% each.